Seconds away from the cash open in New York. Let's get you some price action going into that opening bout this Tuesday morning. Good morning to you all just tuning in. Equities are positive by 1/3% on the S&P. On the Nasdaq 100 up 0.6%. Gains on Friday, gains on Monday. Can we make it gains on Tuesday? There's your opening bout. Switch on the board and get to the bond market. What a year it's been in the bond market for fixed income. Treasuries lower, yields higher. Today the other way around. Treasuries up, yields down by 2 basis points, just short of 420 now, 418.85. Euro clinging on to parity, euro dollar negative, let's call it 1/10%. And at the epicenter of this election debate is inflation, and what happens here. Crude back in the 90s over the last couple of weeks, 91.55 on WTI. We're down 1/4%. That's the price action. Let's get you some movers, and we can do that with Katie Greifeld. Hey, Katie.
Hey, John. Well, I have some good news. If you're a stock bull, this is the best possible November setup for you. The average gain for the S&P 500 in a midterm election year is 2%. If you compare that to a presidential year, that gain whittles down to just 1.1%. And in years where nothing is happening, November delivers just a 0.6% gain. So again, from the perspective of an equity bull, that is purely the perspective I'm talking from, the best possible outcome today is that Republicans take control of just one chamber. If you look back since the end of the Second World War, years with a split Congress have produced the best returns, almost 13% for the S&P 500. If you look at that chart there, years with one party in control, either party, they've trailed the average overall about 8.2% there. And it may not matter too much if recent trends do hold. John, I don't need to tell you that tech has been struggling lately, so much so that the tech ETF's 5-year returns are just about even with XLE. That is the big energy ETF on the street. Given how huge the tech sector is, of course, that's bad news on a benchmark level, John.
That chart is amazing to look at, and Katie, I haven't looked at that yet. That is absolutely unbelievable how much we've taken back from that big tech rally. Katie, great work as always. About a minute or so, 2 minutes into this session, Tuesday morning, equities up by about 1/10% on the S&P, on the Nasdaq up 0.2%. 2 events this week, CPI on Thursday. Before we get there, it's all about the midterms. Red versus blue. Wall Street weighing the market impact of the midterm elections. Morgan Stanley's Mike Wilson on this program, expecting a divided government to keep this bear market rally going.
The midterms, though, however, could have lasting implications if it's a decisive victory for the Republicans. The majority of the inflation spike was a result of excessive fiscal spending, and that, of course, will be curtailed even if the Republicans just win one chamber. Ultimately, it should be good for bonds. Bond yields lower has been key to our tactical rally call.
Bullish for bonds and bullish for stocks. That's the takeaway from Mike Wilson. Laurie Calvasina of RBC echoing that call, writing the following. Equity investors would take a bullish cue from the historical playbook, which indicates that stocks tend to experience above trend gains of 13 to 14% on an average basis in years that have a Democratic president and a split or Republican Congress. Joining us now to discuss is JP Morgan's Clinton Warren. Clinton, let's start here with the so-called midterm seasonality. Is it relevant given the unique moment that we're in right now?
Yes, I think it's very relevant, and I just hope everyone takes the time out of their busy schedules to go out and vote. It's one of the great privileges that we have here in the States. And since 1943, there's been 19 midterm elections, with the incumbent party picking up seats in the House 2 times and seats in the Senate 4 times. So based on what everyone is thinking about this election cycle, with citizens focused on the economy and inflation, there's no surprise that a lot of the pollsters have the Republicans picking up at least the House and even maybe the Senate, which seems to be more of a toss-up. So we are heading into what seems to be a divided government, which, as your chart showed before, seems to be quite positive for the equity markets. What we have seen historically is that volatility decreases as we get some certainty on the political landscape, and markets do rebound nicely. However, I do think the impact of political circumstances this year will be somewhat muted, as we have CPI coming 2 days later on Thursday, which will probably take all the headlines and take all the market participants' thoughts. One thing I will say, though, is that if we do have that deep recession that some pundits are thinking about, a divided government does make it harder for fiscal policy to be passed. Obviously, monetary policy will be something on the Fed's mind, but if there's that deep recession and we need some sort of fiscal stimulus, it may be hard for a divided government to accomplish something to help us get out of that mess.
So Clinton, it raises an important question then. If fiscal policy is constrained because of gridlock down here in Washington, is that a positive on net? If you're saying short term it might be, long term maybe not, is it a positive or not?
I think you have to play out the timeline, right? So a lot of forecasters are showing some sort of recession into the mid to latter parts of 2023. So if that happens, the Fed's going to be going on a rate lowering campaign, and that gets you into 2024, which is another election year and one that will probably be more heated. So I think there'll be things on both sides and motivations on both sides, but it could lead to a harder landing if there is that deep recession that some economists are forecasting.
Clinton, every time we do this, when it comes to the midterms, when it comes to any election, the presidential election, the general, we always talk about gridlock. Clinton, it feels like gridlock is the consensus view, and it makes me wonder whether it's already priced. Clinton, is it already priced?
Yeah, I mean, everyone that I talk to has a divided government kind of priced into the models. I think the biggest question on everyone's mind is what's going to happen in the Senate, and the last polls I looked at is like a 50-50 toss-up. But either way, that leads to a divided government. So yeah, it's going to be gridlock, which slows things down, which makes Washington kind of pause. But I'm just concerned that if there's something that major needs to happen, that both sides will come together and do what's right for the country.
So Clinton, let's talk about the tail risk. We've dealt with the consensus view. Let's talk about the tails. What happens if the Democrats hold on? What is it about that scenario that unnerves investors and clients you speak to?
Yeah, I think a lot of people are concerned about some increased spending that can happen, especially on where we are in the economy on the brink of all the additional spending that we just had coming out of the pandemic. So I think that's one of the biggest worries. And I think people just want to get back to a more normal environment, and we're starting to feel some of the effects of the pandemic hanging over now. That's why you see equity markets down 25%. You see bond markets down 16%. So I do think that tail risk of the Democrats taking and retaining both House and the Senate, the biggest concern would be increased spending, which has some people on pause based on where we are in this economic cycle.
And Clinton, we all understand why this is consequential for sentiment. Can you help me understand from a sector basis how this could be important too? And let's pick out one, let's pick out energy. Energy has done tremendously well, brilliantly, under Democratic leadership. And Clinton, I just wonder whether sometimes we get this all back to front. How relevant is it?
No, it's very relevant. And if you look at just earnings so far, Q3 earnings, the earnings have come in up 3%. If you strip out energy, they're actually down 5% or so. So energy has done well for a number of reasons. I don't think you can just put that into what's going on in Washington. There's a number of other factors that have played into that. So it's something to watch. I just don't know if it's going to be a major impact to that sector in the short run. Obviously, there's longer term impacts with some things on their agenda, but I don't see it being anything to worry about in the short term.
Well, Clinton, let's finish on this bear market rally. You heard from Mike Wilson of Morgan Stanley. He thinks it can continue off the back of the midterms. The events and how the dominoes fall are pretty clear. You get a gridlock, means bond yields fall, equities rally. Is that something you're on side with?
Once again, I mean, I do think the midterms is something that everyone's going to be watching, but we have inflation data coming out, CPI, on Thursday, and I was trying to think of some sort of analogy. And to me, inflation is like roaches. The Fed just can't get rid of it. They're throwing everything at this problem, and they just can't get rid of it. And that's going to be the thing that's going to take the headlines. It's going to take market participants, and that's the only thing that folks are going to be thinking about come Thursday morning. So yeah, there's going to be some short-term noise. The market's going to move Tuesday, late Wednesday, as things are starting to get results on Thursday. It's going to be old news as everyone's going to be focused on what the Fed's going to do and what's happening with inflation.
Hey, Clinton, awesome to catch up. Clinton Warren there of JP Morgan Private Bank. Right now, the equity market essentially unchanged on the S&P 500. On the NASDAQ, we're positive just 0.03% going into a major event. And then from here, it's on to CPI on Thursday, looking for year-over-year inflation to come in just inside of 8%. Of course, Wall Street very focused on that core month-over-month figure. Coming up on this program, U.S. voters heading to the polls with all eyes on Pennsylvania's Senate race.
Social Security and Medicare is in the ballot. There's something else on the ballot. Character. John has character, integrity, and he's going to be a hell of a good senator.
That conversation still ahead.
I'm here to ask you to vote.
You have to get out. You have to vote.
Democracy is literally on the ballot.
The stakes are high.
Our country has never been so bad as it is right now.
Under my predecessor, the economy was in ruin.
Let me tell you something, Pennsylvania.
John has character, integrity, and he's going to be a hell of a good senator.
The people of Pennsylvania are going to elect Dr. Mehmet Oz to the United States Senate.
This is a defining moment for the nation.
The biggest names descending on Pennsylvania as the race between Fetterman and Oz takes center stage.
Everyone that's willing to go out and go knock on doors and to get out the votes right now, because there is just so much at stake right now in this race right now.
I don't have to come up with any brilliant new ideas. You actually have them all. And we have the answers, the solutions. But John Fetterman's not one of them.
I won my very first election by one single vote. Got knocked down at the stroke, but we're back up and we're taking it all across.
Bloomberg's Katie Lyons joins us now from Philadelphia. Morning, Katie.
Morning, John. This is an incredibly close race, and one that is crucial because it ultimately could help decide the balance of the Senate. The seat in question is that of retiring Republican Senator Pat Toomey. So this is one of the Democrats' best opportunities to flip a seat. Of course, the man trying to do that is John Fetterman, the Democratic candidate, up against Mehmet Oz. Fetterman had been holding a lead throughout this entire campaign, but the latest polls this morning, the 538 aggregate polling, shows that Oz is ahead by 0.5%. So this is going to be a nail-biter race, and because this is Pennsylvania, because the rules here dictate that you cannot start counting mail-in ballots until 7 a.m. on Election Day, so really just a few hours ago, it means we may not have results for this race for several days. Already 1.1 million mail-in ballots have been returned, so that is a lot to count. And then if the margin of the ultimate tally is less than 0.5%, this vote would go to an automatic recount. And if you trust the polls, it does indeed look like the race could be that close. And of course, if Fetterman is able to pull it off, if this does flip to a Democratic seat, that means the Republicans would have to win at least 2 out of 3 in Nevada, Arizona, or Georgia. So that is why all eyes are here in Pennsylvania today. Turnout is high, voters are mobilized, and we are going to be looking for results for possibly the next several days, Sean.
Kelly Lyons, thank you. AMH right here in Washington, D.C. I want to continue this conversation. Anne-Marie, let's build on this Pennsylvania conversation. Given who is campaigning in that state, is this kind of like a proxy war, an appetizer for the general in 2 years?
That's what it feels like, right? You have the rock stars, the Democrats, the rock stars of the Republicans, all coming because, as Kayleigh says, this is a chance for Democrats to flip that seat. And the reason why they need to flip it is not to gain an edge in a very thin majority they already have in the Senate. It's because they're likely going to lose in some other places. You look like Nevada. They may lose that Democratic hold in Nevada. So this is incredibly important. But also, Jonathan, 2020 presidential election, it came down to Pennsylvania, and it can potentially come down to Pennsylvania for this midterm.
There's a whole host of races we could talk about. That's one. Let's talk about another. The governor race in New York.
Oh, yeah.
It's remarkable to see the President of the United States campaigning in a state that he won by, I think, 23 points back in 2020, the weekend before the midterms.
Democrats
if you told me
carry
10 months ago that this is what was going to happen, I don't think many people would believe me.
I'm shocked. I grew up in New York. We haven't seen a Republican governor since George Pataki. This is something that most Democrats in New York are shocked about, and the fact that is so last minute, like, descending on, almost chaos it feels like, in terms of them trying to get these votes out in a place like New York. The President of the United States is in Westchester County, in Bronxville. You've been there. That says a lot and how worried they are about Tuesday's election. What was the front page of the New York Post today? That they want their streets back, and they're endorsing a Zeldin.
It feels panicky. Let's talk about something else here in the market. In the market right now, and we're lower by not even 1/10%, I've got a long list of guests who have all said gridlock positive for markets. Can you paint a picture for everybody about what gridlock's going to look like for the next 2 years in Washington, D.C.?
I guess they like gridlock because it means there won't be any big legislation in terms of changes, like taxes, etc. But when you have gridlock, the most worrisome issue on the docket for this new Congress is going to be the debt ceiling and the fiscal cliff. And when you have gridlock, that's going to be incredibly challenging for them to get through, which is why you have Senator Bernie Sanders saying we should handle it now in the lame duck session before the new year. So gridlock may sound nice in terms of big picture items for the market, but it's still going to be incredibly troublesome to get some of really big picture items like the debt ceiling, like making sure the United States can pay their bills, getting those votes.
You'll be busy, so will Mike McKee. Mike McKee joins us now out of New York City. Mike McKee, are we going to do this all over again?
Looks like we're going to do it all over again. Now, the important thing to realize is the debt ceiling doesn't limit debt. The government can spend whatever it wants. It limits the government's ability to pay for that debt. And the problem is not just gridlock, but the Republicans are coming to power saying they are going to hold the country hostage and perhaps default in order to force Joe Biden into some spending cuts. You can see how close we are there to the debt ceiling. Might hit it in the next month or so. We're only about $200 billion below that. And of course, we've been through this many times before. The government, the Treasury Department, can use what they call extraordinary measures, ways of postponing bill paying, essentially, to stay below it for a while. Bloomberg Economics thinks they can get to late 2023, but that months of drama will weigh on the markets, and the Treasury will be issuing fewer bills because they're going to try to stay below that limit. That will cause problems for money markets. Interest rates will rise. So what happens? Well, what Wall Street thinks will happen is the Republicans will cave before the default because nobody wants a default, and they'll possibly make a spending deal with Biden. And the Fed's reverse repo facility will provide T-bills to the market, so we won't have problems there. But what could happen? The U.S. could default on its debts. We came very close a couple of times in the last decade. Treasury and bond markets would seize up. The U.S. debt would be downgraded, interest rates permanently higher. Oh, and there's one other thing. The government has a temporary spending bill in place until December 16th, so the possibility of a government shutdown looms if the Republicans want to move this to the confrontation status as well. The problem, John, is that nobody knows how serious the Republicans are about holding the country hostage, but it is something Wall Street's going to have to pay attention to for the next year.
Can I just say that I'm so happy that I don't have to follow this and you guys do it for me, because this is going to get ridiculous quickly. AMH right here in DC, Mike McKee over in New York. You've heard it a million times, haven't you? Gridlock is good for this equity market. Gridlock might be the optimal policy stance for this market right now. The question we've got to ask in markets is whether that's the policy stance we need, we want, if we're in a recession 12 months from now. And that's an ongoing debate, and we'll keep having that conversation on this program. On the S&P, we're positive by almost 0.1%. Really no price action to speak of at the index level. On the NASDAQ, we're down by just 0.02%. Let's get you some sector price action. We can do that with Katie Greifeld. Hey, Katie.
Hey, John, I'm going to try to make this interesting. Like you said, the S&P 500 just about flat. If you look on the sector level, you have 7 higher, 4 lower, not too much action on either side. We're talking less than 1% moves. You do have materials leading to the upside, energy to the downside, and it's energy and big tech that I want to talk about as we wrap it into this midterms conversation. Obviously, both groups have a lot riding on this election. The progressive wing of the Democratic Party, of course, has expressed the possibility of breaking up big tech. Think Microsoft, Amazon, Apple. On the other side, meanwhile, the White House potential windfall tax on big oil means that the stakes are high for the energy sector as well. But as you can see, both not doing too much. Those outcomes become less likely with a split Congress or even Republican control. John, I did want to talk about Take-Two Interactive briefly because we are still in earnings season. You had the video game developer report last night, and it wasn't too pretty. You had weakness in the mobile business that led to a cut in booking guidance. As you can see, shares are down double digits. That's bringing down the overall video game group just slightly today, John.
Katie, thank you. Wonderful, as always. About 22 minutes into the session, we're up 0.1% on the S&P 500. Coming up on Election Day in America, the closing arguments, and of course your trading diary through the week ahead. From DC, this is Bloomberg.
Jobs Day, like Bloomberg.
We're just hours away from the most important midterm election in American history.
Remember, the power's in your hands.
We're going to take back the House. We're going to take back the Senate.
You wait. Democrats get blown out on Tuesday.
There's people running for office that want to take away our rights. Democracy is on the ballot. It is.
They spent trillions of dollars and printed trillions when they were warned, if you do this, you are going to drive inflation through the roof.
One of the two major political parties in our country openly flirting with political violence, and we have seen the results that brings.
We're possibly one day away from losing this country.
Well, there's a lot on the line in this election.
It's a country-saving election.
We just have to remember who in the hell we are. We are the United States of America.
The final word from the President of the United States. The closing arguments are in, the results are hours away. The price action going into it all looks like this. A third day of gains on the S&P 500. Muted price action this morning, as you might expect, 25 minutes into the session, up by 0.25% on the S&P. On the Nasdaq 100, up 0.6%. The state of play in the bond market looks like this. 2s, 10s and 30s. Two-year yields come in 4 basis points. 4.68 on a 10-year, down 5 basis points to 4.1591. Your trading diary. Midterm elections underway. Congress up for grabs. You know that already. More Fed speak through the week. Wednesday with Williams, Barkin, Kashkari all on deck. It continues with Waller, Harker, Logan, Daly, Mester and George all speaking on Thursday. Plus, we get another round of jobless claims. And the main event, according to so many of you, it's not right here in Washington. It's not the vote. It's CPI on Thursday from Washington, D.C. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, November 8th. Here are the top market stories that we're following for you at this hour. Midterm mayhem. Polls open in the U.S. with the House expected to turn red, the Senate still up for grabs, an early verdict on President Biden and a possible Trump 2024 presidential run. Election impact. Markets just wait for results. Stocks mixed, bonds bid, dollar up. And crypto contagion. Investors pull hundreds of millions of dollars from crypto exchange FTX, causing tumult across the crypto world. We're going to break down those risks. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, we made it to election day. Markets are waiting. How long are they actually going to be waiting for? To me is now the question.
It could be quite a long time, and that's going to be a huge problem for markets which want to price in certainty, but they may not get that today. Today is a day of no news in so many ways, Alex. Today is a day of what-ifs, and as a result of which we're going to have to speculate until we get those results. But as you say, that could be a while. And that, I think, is going to make this fascinating. How's that going to affect how markets trade? How is it going to affect the political prospects of people like Donald Trump? So much to talk about, so much to think about, but no news.
No news yet. And then also we get Thursday CPI, and that could be news. But I feel like tomorrow's going to be about digesting, today is about waiting, and then we see and we get the lay of the land on how much we know when for the Senate and the House.
Absolutely. So let's go live to some of the key areas that we are watching in the United States today. Kaylee Lines is in Philadelphia. Bloomberg's Billy House is in Atlanta. Georgia is going to be fascinating. Anne-Marie Hordern is in Washington to kind of wrap it all up for us, give us the big picture perspective on what is happening here. Kaylee, let me start with you. You're in Pennsylvania. You're covering what is largely being perceived as the marquee race. We've got Lieutenant Governor John Fetterman, TV Dr. Mehmet Oz, both running for the Senate, and it is this close. It is so tight. Talk to us about how tight it is.
It is ridiculously tight, Guy. This was a race that hadn't always been tight either. It has tightened so materially in recent weeks to now, today. It actually looks like Oz is ahead in the aggregate 538 average of polls by about 0.5% after Fetterman led for most of this campaign. So really, this is going to be a nail biter. And as you and Alex were just discussing, it could be some time before we actually know which man came out on top, because here in Pennsylvania, the rules dictate that you cannot begin counting mail-in ballots until 7 a.m. on election day, so that more than 1.1 million mail-in ballots that had been returned as of yesterday have only been being counted for about 3 hours. So election officials have warned that means we likely will not have results tonight or even tomorrow morning. It could be days. And of course, that means it could be days before we know what the ultimate balance of the Senate is. The reason this race is so crucial is because the seat in question is that of retiring Republican Senator Pat Toomey. So here in Pennsylvania, it is seen as one of the Democrats' best opportunities to pick up a seat. Time, and I mean time, will tell which man comes on top. But right now, Oz is ahead in the polls, ahead of Fetterman. Of course, Fetterman's suffering still from the effects of a stroke he suffered back in May, just before he won the Democratic primary. That was on display in a debate televised here just about 2 weeks ago, and that seems to be one of the factors contributing to the lost ground he has witnessed in this race.
All right, Kaylee, great reporting. Thank you so much, and for battling the wind and the elements there. Kaylee Lines joining us on the ground in Philadelphia. So another key battleground state is Georgia. It is the first among the races to watch to complete voting, but could be the last to actually determine a winner. Joining us now is Bloomberg's Billy House. Billy, this also could be quite contentious. This also could lead to a runoff election. Walk us through the numbers here.
Absolutely. When you talk about uncertainty, this race is not only going to be decided by who gets the most votes, it could be decided by whether or not tonight anybody gets 50% or more. If not, we're going to have to wait till December 6th, the runoff between the top two vote getters. Of course, this pits Democratic incumbent Raphael Warnock, elected in a runoff in 2021 against former football star Herschel Walker, in a race that has seen Walker's baggage come to the fore, personal baggage, domestic violence, women saying he urged them to have abortions. But Warnock himself has been tied directly and repeatedly by Republicans to the agenda of Joe Biden, which has seemed in the last few weeks the race to kind of even up. But both are in the 40s. There's a third party candidate, a libertarian, who's drawing, according to polls, about 5%. So this race is anything but clear-cut, and it could also remain so after tonight.
A lot of ambiguity. That seems to be the message here. Billy House, great stuff. Thank you very much indeed. On the eve of the midterms, of course, we're thinking about what happens in 2024. Former President Donald Trump speaking at a rally in Ohio saying that he will be making a big announcement next week.
This is the year we're going to take back the House, we're going to take back the Senate, and we're going to take back America. And in 2024, most importantly, we are going to take back our magnificent White House.
Let's go to Washington, D.C. and talk about what happens next. Bloomberg's Anne-Marie Hordern joins us now. Anne-Marie, to what extent is this midterm election about Donald Trump's future?
Well, he said, Guy, he's going to make a very big announcement November 15th. It's the announcement before the announcement. He was ostensibly supposed to be campaigning for J.D. Vance, the Republican candidate for Senate, but he said that he didn't want to announce what he had to announce there because he didn't want to take away from Mr. Vance. But I think he certainly did, because the headlines say are the fact that he will be making his third bid for the White House. A lot of this midterm election has a lot to do with the former president as well as the current president. When it comes to the former president, it's the candidates he backed, like J.D. Vance in Ohio, like Blake Masters, like Herschel Walker that we just heard Billy House talk about, like Mehmet Oz in Pennsylvania. So we have to see how those candidates do first, I think. But what is obvious is that the second this midterm election is done, I guess even before this midterm election is finished, everyone is focused on the presidential race in 2024. And when the former president comes out and announces, that's going to put a lot of pressure on this White House to put Joe Biden up as well for 2024.
Well, Anne-Marie, how is the White House going to be interpreting tonight's results? Are they going to be looking at it as a referendum on Biden? And then how does that lead up to 2024?
So the president acknowledged yesterday, coming off of Marine One after a rally in Maryland, that it is going to be tougher for the Democrats to control the House. He said over the weekend that he thinks they're going to keep it, but he acknowledged that these numbers are getting tougher. The Senate, according to 538, maybe a little bit edged the Republicans, but it's really a dead heat. So if he loses both chambers, there's no question that they're going to have to really look at this, that this was a referendum on the Biden administration. And that might make it harder for him to get that nominee in 2024, because those quiet whispers about whether or not this Democratic Party thinks that Joe Biden, who is going to be 80 at the end of this month, so you could say the same for the Republicans, who wonder if the former president who lost the last election in his late 70s could also be that candidate. But those whispers in the Democratic Party for maybe a fresh leadership, those whispers might become much louder.
Anne-Marie, what does gridlock mean? What gets done? What doesn't get done?
Jonathan and I were just talking about it because Wall Street says they like gridlock, but I'm not sure they're going to like it in the long term. I think short term it sounds great for them in terms of, okay, we know there's not going to be any massive changes, but you have a debt ceiling very soon that's going to come up. Mike McKee just mentioned the stopgap funding measure, making sure the government stays open. That's going to come up. This could mean that we are potentially going to have very, very difficult negotiations between these parties to make sure that our financial house is in order in the United States. And I don't think the markets are going to like if we come up to a so-called fiscal cliff.
All right, thanks a lot. Really appreciate it. Bloomberg's Anne-Marie Hordern joining us there. And tune in, of course, to Bloomberg's special coverage of the midterms anchored by David Weston. It begins tonight at 8 p.m. at New York time, so stay with the team and him for that. All right, coming up, what markets are going to be watching in these elections? Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist, will be joining us next. This is Bloomberg.
tonight. As Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tomorrow, tune in to Surveillance live from D.C. at 6 a.m. for the latest overnight. This is Bloomberg.
Inflation should come down, but don't expect its drop to be immediate or predictable. We've been through multiple shocks, as I discussed, and significant shocks simply take time to dampen.
That was Richmond Fed President Tom Barkin on efforts to tame inflation. Our question of the day has to do with the short-term impact, though, of elections. What's the election impact? I want to ask Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. He joins us now. Peter, I say short term, but this can also have long-term implications, particularly into 2023. As you look at what we're seeing in the equity market, S&P up 0.3%, what is going to be the election impact?
Well, you were discussing earlier that elections may not matter if they result in some kind of gridlock, but I think it depends very much on the circumstances, and we have to see this election in the context of growing global uncertainty about political outcomes, geopolitics, and of course the macro prospects of where inflation peaks and what impact will it have on growth. So I think in a very uncertain world, elections and uncertainty about what that may result in is just going to add to risk premia and volatility. So in that sense, I don't think this is going to compound other issues which investors are very uncertain about.
Peter, a lot of people ascribe the current inflationary surge that we're seeing to the fiscal impulse that we saw coming out or during COVID. If we get gridlock in DC, is that disinflationary because you don't continue with that fiscal largesse?
Well, I think it's a complex mix here of inflationary drivers. Some of it is about excess demand that came from accumulated savings through the pandemic. And that demand surge has caused inflation, particularly when supply has been disturbed by the effect of the pandemic. But part of it is also about supply side issues, long-term underinvestment, for example, in energy, tighter labor supplies and labor markets. And it's not clear that raising interest rates is going to be a resolution to that. And it's not clear that some gridlock in terms of politics and the inability to respond at all fiscally will also be a resolution to these longer-term complex problems.
But Peter, what it does seem to point to is the risk that we hit a recession next year in the U.S. and at the same time don't have the kind of government that can just start pumping money into the system. So if we have more fiscal tightening at the same time where we get a recession, how does that then potentially affect your outlook?
Well, I think, as you say, that's a clear additional uncertainty. Let me emphasize, though, that we don't think the U.S. will go into recession next year. Our economists put the probability at around 35%, and there are some reasons to be quite positive. But of course, investors don't know that for sure, and the extent to which any weakness in data may increase the implied probability of recession with limited levers to do anything about it, that again will increase, I think, risk premium in risky assets. And, an additional reason why we think that what we're seeing at the moment is a bit of a bear market rally, and we'll see more volatility in risk assets in the nearer term.
Peter, therefore, should we as investors continue to focus as our primary North Star on inflation rather than concerns around recession and growth?
Well, I think that in the current context, yes, because inflation and rising interest rates were really the root cause and trigger of the bear markets that we've seen, not just in equities, but across all financial assets over the course of this year. Let's not forget, if you take a sort of 60-40 equity bond type of benchmark, we've seen the worst year for many, many decades. And that's really been triggered by the shift upwards in inflation expectations and interest rates. So the progress towards peak inflation and towards a peak terminal rate and the confidence around when we might see the other side of that is really going to be instrumental, I think, to any sustained recovery in risk assets and financial assets more broadly.
So in the meantime, go with your call. How do we protect ourselves? How does an investor protect against that?
Well, we continue to be pretty cautious in our asset allocation. We're overweight of cash. We're actually underweight of equities and risk assets in general. We're overweight of commodities. We're structurally bullish about that because of the supply side issues that I mentioned earlier. And of course, protect in diversified portfolios a little bit for higher inflation. And I think within risk assets like equities and credit, we're upping quality in terms of exposure and really focusing on companies that have more sustainable, predictable margins. Because I think another important shift that we're seeing relative to the last cycle is when record low rates really focused investors on revenue growth and paying a big premium for it. Now investors are much more focused on margins and the ability to sustain earnings. And I think that will continue to be a driver of relative returns over the coming months.
Peter, I'm trying to wonder what the kind of tail risks look like right now. Clearly, obviously, monetary policy, extreme monetary policy is one of them. Politics, we're talking about the midterms today, could be another. But the other one that's emerged over the last few days has been China. There has been no news. There has been no clearly orchestrated move towards ending COVID zero. Yet what we've had is a foretaste of the kind of volatility that we could see were that event to transpire. Peter, how should, as a global investor, you think about this? How should you position for it? Should you position for it?
Well, I think that we have to acknowledge that the economy has been really very weak this year as a result of tightened policy, zero COVID, and many other factors that have combined to generate that outcome. We do expect some stronger growth coming through, but I think perhaps the way to think about this relates to those other inflationary issues that we were discussing. At the moment, global demand for energy is probably at a low, and if and when China opens up or its economy recovers, demand for energy is going to increase, and that's likely to push up commodity prices, particularly things like oil, from these more moderate levels that we've recently reached. So again, to the extent that that's been an inflationary driver, or at least a driver to higher interest rates, that's another factor that I think we have to think about in relation to China's impact on the global economy and markets.
Inflation right at the center of everything. Peter, thank you very much indeed. We always appreciate your time. We really appreciate your thoughts. Peter Oppenheimer of Goldman Sachs. Still ahead, we'll turn to some of the single stocks that we're focusing on. Lyft, very much under pressure. Shares slumping the most in 6 months. This after the company reported weak ridership growth. There is concern around revenue. There is concerns around costs. Investors react strongly. We'll talk more about this story next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. U.S. credit card balances surged to a record in the third quarter. Banks are betting that consumers with less than stellar credit will be able to handle more debt. According to credit reporting company TransUnion, balances soared 19% to $866 billion. The number of new cards given to subprime customers climbed more than 12%. Nintendo has cut its fiscal year forecast for Switch console sales by 10% to 19 million. The Japanese company blames the shortfall in part on a prolonged chip shortage. Nintendo says it's now front-loading production to maximize delivery in the holiday shopping season. And in France, the utility EDF is investigating an incident during a test last week at a nuclear reactor that had been halted. EDF had to stop a hydraulic test involving its Civaux 1 reactor when steam was released. The reactor wasn't loaded with nuclear fuel and no radioactivity was detected outside the building. EDF is completing a series of repairs on reactors that could jeopardize France's power supply security. And that is your latest business flash, Guy.
More good news on the European energy front. Ritika, thank you very much indeed. Let's talk some single stocks. Lyft's latest results show it's losing ground to Uber. That seems to be the big takeaway. Shares very much under pressure, weaker than expected. Ridership growth a key factor behind this. Joining us now is Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence. Mandeep, there's concern around revenue, there's concerns around costs. Which of those two factors is the biggest worry for investors right now?
I think what you see in the Lyft results is the headwind from inflation. And pricing did get a lift from, higher prices, inflationary tailwind. But in terms of the cost side, the gross margin, that was the big sticking point last night. Their gross margins compressed almost 10%. And part of that has to do with insurance. So in my mind, they are clearly paring back their subsidies. That's hurting them on the supply side, as well as, bringing more riders. They missed on adding active riders. And the cost side, clearly, when the company is under gross margin pressure, they try to offset it with headcount layoffs, and that's what you're seeing, with what the company is doing. But not a good outlook given what we heard from Uber. They're talking about 30% growth. In the case of Lyft, they guided to 20% growth last night.
Hey, Mandeep, what's the correct PE ratio I should be subscribing to Lyft? I'm looking at the terminal estimated PE 30 times.
Well, and if you look at it as a, EV to sales basis, it's almost 1 times EV to sales. So clearly a lot of bad news is priced in. Talking about this company really falling off the cliff. That is certainly what has happened here. But in my mind, there may not be a speedy recovery because this was probably the best setup in terms of reopenings and, people traveling. And the fact that they are under pressure to cut costs and they're barely EBITDA profitable on an adjusted basis, they're still issuing a lot of new stock, which obviously is hurting, the stock composition overall. But in my mind, there is a problem at the top line level, given the rider kind of deceleration that we have seen. And the cost side is just not in their control. If inflation is a headwind and it's going to persist, it's not going to ending anytime soon.
Why didn't the market see this one coming? You're getting a big reaction today. Is that reaction commensurate with what we've heard from the business?
Yeah, so the reason why market reacted so strongly because Uber told us that, they expect mobility to grow 30% plus. Now, Lyft really took down their guidance. And remember, Lyft is about 3 to 4 times smaller than Uber. It's focused on the U.S. So clearly, Uber seems to be executing better, and they told us Uber supply is back to 2019 levels, whereas Lyft is about 75% of 2019 levels. So execution issues.
Yeah, no kidding. Hey, Mandeep, really great. Always appreciate it. Mandeep Singh joining us from Bloomberg Intelligence. All right, coming up, let's take a longer-term outlook for a second. JP Morgan, bullish on long-term returns for the 60-40 stock bond portfolio. We're going to speak to the authors. This is Bloomberg. We're about an hour into the U.S. trading session on Election Day. Stocks a bit higher here. The Nasdaq 100 now up by 0.7%. Hard, though, to take any of that really seriously. Katie Greifeld tracking those moves for us. Katie?
Well, Alex, just in the last half hour, we've seen a little bit of life come back into the big benchmark. We're looking at the S&P 500 right now, up by about 0.5%. But as you can see, since futures opened last night, we've been really back and forth as live voting does begin. But we are moving higher right now, and a lot of that action is coming from the tech sector. Specifically in the chips, you had GFS, that is a U.S. custom chip maker, give a pretty bullish forecast that's lifting up the rest of the sector as well, from NVIDIA to Applied Materials. So we'll see. Tech today having a good day, but if you zoom out, I am obsessed with this next chart. It's pretty remarkable. We're looking at QQQ, that is obviously the Nasdaq 100 tech ETF, versus XLE, that is the energy sector ETF. If you look at the returns over the past 5 years, you can see that energy is really narrowing the gap here. We're looking at about 68% total returns over the past 5 years. Tech is still in charge with about 80% gains or so over the past 5 years, but that gap, again, really narrowing. And both of these groups, of course, have a lot riding on the midterm elections today. But if we zoom out and look for the overall benchmark, the S&P 500, it's interesting. Just for the perspective of equity bulls, the best outcome would be a split Congress, for Republicans to take control of just one chamber. Since the end of World War II, and hopefully we'll have the chart behind me soon, the average gain in that year is about a 12.9% gain. As you can see, that's higher either in all Republican or in all Democratic Congress, and it's well above the average of about 8.2%, Guy.
It's amazing, isn't it? Looks like we're going to get gridlock. That looks pretty positive, judging by the chart you've got behind you. Katie, great stuff. Thank you very much indeed. Alex, I want to talk about a story that went live on the Bloomberg just a few minutes ago, and it's having quite a meaningful impact on sterling. It's a Bloomberg story that is titled, UK and EU are close to a breakthrough in long-running Brexit splat. What this is basically talking about is Northern Ireland and Northern Ireland trade. This has been a huge and controversial subject between the UK and the EU, and of course within the Conservative Party. But you can see how that story has translated into a material rise for sterling. We're north of 115, 115.30 is where we're trading right now. This comes down to data. It doesn't resolve all of the issues, but it comes down to data and the possibility of the fact that we could be seeing a situation where the UK government and the EU may be inching closer to a point where they're able to share data on trade, and that would remove some of the really big issues around Northern Ireland. Now, it doesn't remove all of them. The legal process, the European court's jurisdiction over Northern Ireland is still a major sticking point, but this would go a long way to resolving some of these big problems that have hung over this relationship. Sterling reacting quite strongly to it.
Yep, and it feels like another win then, in some respects, for Rishi Sunak, because this was not the conversation a couple weeks ago under Liz Truss. So Rishi Sunak's government really sort of pushing that through in many ways there. All right, let's get back to the idea of short-term versus long-term. So we're talking a lot about the election impact, right? And how do you deal with that over the next couple of days? But how do you deal with that over the next couple years is also a very important question. Lower valuations and higher yields could now be providing asset markets the best return on a long-term basis in over a decade. This is a key takeaway from JP Morgan's latest long-term capital market assumptions report. The authors, David Kelly, Chief Global Strategist, and John Bilton, Head of Global Multi-Asset Strategy, joins me now here on set in New York. As David told me before we got going, he's like, I'm the eco guy, John's the market guy, but they're kind of like the same. So to that point, you say specifically 60-40 portfolio could get up to 7.2% returns. That's like almost double what we've seen in the last 5 to 10 years, right? David, walk me through the significance of this.
Well, I think so much has happened this year, with Ukraine, with elections, with oil, with inflation. But the most important thing for investors is actually prices fell. And we had this unusual situation with the stock market really falling a lot, but also long-term interest rates going up. And, as we worked on this project, that really had a big impact on our future returns from here. So these are the best prospective returns we've seen since 2010.
So is this all about John, like bonds being a good investment now?
Yeah,
That's what
well,
this is?
I mean, I think bonds are definitely back. Let's call it what it is. You can have a situation where you're clipping a 4.1, 4.2% coupon on a US 10-year. We think the fair yield over the next 10 years is nearer 3.2. So you've got the wind at your back. You've got price gains to come as well. So the crucial thing, it's been a valuation move and it's been a yield move. It's not been a fundamental deterioration in the underlying assets that have gotten us to 7.2% expected return on a 60-40, up from 4.3 last year. It's been a reset of some of those long-standing dislocations.
John, is my income going to be significantly higher from a 60-40 portfolio going forward from here? I need to inflation adjust. A lot of people need to think about what kind of inflation rate they're going to be thinking about if they are planning long-term portfolio management. What are you guys assuming on your outlook?
Well, perhaps I'll take that one. So I think one of the key things here is we've seen a big change, obviously, in valuations, but our long-term outlook hasn't changed that much. In U.S. inflation, for example, last year we thought the long-term inflation rate would be about 2.3%, and now we're up to 2.6%. But that's it. We do think that, because this is looking out over 10 to 15 years, central banks are very aggressive right now. They're dealing with a big inflation problem, but we're basically saying they're going to win. The economy is going to slow down, inflation will come down. We're looking at slightly less growth because we're starting from basically full employment. But we haven't seen that big a change in the economic fundamentals here. What's really changed is the price of financial assets.
Okay, I'll pitch another one to John.
He's ready to jump in. He's good.
Yeah, but David's ready. John, if I'm in London or if I'm in New York, how different an approach do I need to be taking? How big a factor is currency going to be?
It's a huge factor. It's really important. The dollar is at the highest level of valuation guide that we've seen since the 80s, since the Plaza Accord period. And, if you are investing as a US investor, international assets over the next 10 years on average should get a significant tailwind. A couple of percentage points accruing each year for things like euro-based assets. And of course it swings around the other way. So for a euro-based investor in a 60-40, the numbers are smaller because you've got the currency effect on US assets going against you. But what's really important is it's not just US assets that have cheapened up. European assets, UK assets, emerging market assets. It's a great entry point for all of them. And I think the real message is wherever you are in the world, you have an opportunity to build a balanced portfolio using all of the toolkit with many fewer compromises in your portfolio construction today than a year ago. And it's time to really look out to the long term and actually focus on those portfolio goals.
John, to that point, how much of credit is in that bond part?
So we use US Ag, really in that 60-40 makeup. So you've got a high-grade credit component. You've also got a mortgages component, but it's predominantly duration that's driving it. If I look at high yield, we are in a situation where we've seen the return outlook leap for high yield, and it sits between equities and credit, and government bonds as we'd expect. But again, you've had around about a 300 basis point move higher in expected returns from credit. Looking forward, we expect the same kind of level of defaults and recovery rates that we've seen historically. And so, as at an entry point today for a long-term investor, you're getting on towards 7% from high-yield bonds.
David, if the central banks, though, succeed, do they break stuff before they succeed?
They may break stuff, but we think they'll break it in a fairly small way. I mean, we think we could get a mild recession in the US. We certainly could get a mild recession in Europe. But then the economies will resume growth. And I think that we still think slow growth in the long run. We're looking at 1.6% real growth in the United States in the long run. But I think again, it's really about what you're anticipating. I mean, a year ago we were pricing for perfection. Today we're sort of discounting for disaster. And that is the huge change that we've seen. So I think while everybody, with the election on today and with everything that's going on, people are cautious. It's been a very bad year. It's been a very volatile year. But this is really a time to take a look across the board and see where the opportunities are. I mean, one of the things I noticed from the report, as we finished it, is for for international equities in Europe, in Japan, and in emerging markets, for all of them, when you take the currency and the valuations into account, we're looking at average gains of more than 10% per year over the next 10 to 15 years. I mean, those are really good long-term gains, and I think not enough people are invested there.
Yeah, I think, I mean, ultimately...
David, sorry, John.
Not at all. I mean, ultimately, I think you can apply some simple rule sets to this. And again, with the equities, it's worth noting, in terms of the returns we expect from US equities alone, which have gone up to 7.9%, if you apply a simple discounting rule, we've halved the length of time that it takes to double your monies on expected returns from equities. That's a big deal. If you're thinking about building for the long term, it's been right to have a bunker mentality this year in 2022. But if you stay in the bunker too long, you miss when the dust starts to settle. And that's really the call to arms on this particular report, is it's time to start pivoting conversations to that long term.
David, is the dust going to settle? For the last 10 years, central banks have depressed volatility. They've pushed volatility down. That may not be there going forward in the same way, as we've had financial repression. What kind of volatility should I expect in a portfolio going forward, and how should that change the way that I approach risk?
Well, I think we've got a bumpy year ahead of us, because I think central banks really aren't, I think they feel uncomfortable with the level of inflation. I don't think they really know exactly what they're dealing with here. But we're pretty confident, looking at lagged effects, that inflation will come down. We may end up with recessions, but I believe that, by the middle of this decade, we're going to be pretty close to where we were the middle of last decade. So the central banks will pull back, and I think volatility will also pull back.
Does that increase volatility? Does that increase volatility?
Not long term. I mean, we do expect somewhat more volatility now than we did a year ago, but I think it's still nothing like that. We're seeing sort of all the short-term volatility, but we think long-term volatility hasn't moved up that much. Maybe a little bit more in the past, certainly when it comes to inflation, but it's not the most meaningful thing in our long-term forecasts.
Great to catch up, guys. We always appreciate your time. Thanks for dropping by and coming into the studio. David Kelly and John Bilton of JP Morgan Asset Management. Thank you very much indeed, guys. Coming up, US voters are deciding the control of Congress, state capitals across the country. We're going to break down the odds and what they mean for markets. Kim Wallace, 22V, research head of Washington Policy Strategy, joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. When it comes to its future sources of energy, Ireland is banking on the wind. Prime Minister Michael Martin spoke to Bloomberg at the UN Climate Change Summit in Egypt.
We have a great asset, it's wind, and wind off the shore in Ireland is particularly strong, and we are in a position by 2030 to have 80% of all electricity generated by wind.
Martin also said that there needs to be new financial tools to help countries deal with weather disasters. Bloomberg's learned that the European Union is preparing to impose more sanctions on Iran over a deadly crackdown on protests. The proposals would target several Iranian individuals and entities. Nationwide protests began in Iran in September after the death of a young woman who had been detained by police for allegedly breaking Islamic dress codes. And millions of Americans are delivering their verdicts today. They'll decide whether Democrats or Republicans have the right ideas to guide the U.S. through inflation, a possible recession, and splits on cultural and social issues. If Republicans regain control of Congress or even just one of the two chambers, President Biden's agenda would grind to a halt. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta, Bloomberg.
All right, thanks so much, Ritika. So it is election day here in the U.S. for midterms. I did some early voting, but there's still tons of voting taking place today. You're looking at a live shot in Palm Beach, Florida. It looks a little bit windy in a polling place. So talking about how the market is going to be digesting the next 24 hours and potentially the next couple of weeks. We're going to get to Kim Wallace, a 22V Research Senior Managing Director and Head of Washington Policy Strategies, taking a look at the implications here. We have the chart that you had in your notes, which talks about united GOP in control of Congress will mean a risk on for 62% of investors. Now, if Democrats retain the Senate but lose the House, it's 65% of investors see it as risk off. This is a great sort of analysis of what we want to get into. Walk us through your thinking here. What's going to be the issues that are going to move the markets in this direction?
Well, you know, that was the survey results of investors who responded. They see risk on largely because of a sweep in Congress of Republicans that would block Democrats and the president's agenda that they fear might include more inflationary agenda. My sense is that all of this discussion in advance of the election will be overtaken in 2023 by a focus on macroeconomic risks and policies and geopolitics as well. Frankly, my sense is that the outcome of the midterm election in the U.S. is a risk factor for markets, but it's in the middle of a pack of a list of 6 of them, macroeconomic policy and adjustment to it being number 1.
Okay, so how does the midterm election affect all of those factors? How does it affect Ukraine? How does it affect the macroeconomic outlook? Let's start with that and focus on it a little bit more specifically. Will this midterm election be disinflationary? I.e., if we get gridlock, does that mean that DC spends less?
Not necessarily, Guy. DC doesn't have a very good track record for prudent fiscal management. I don't expect that to change in the next 4 to 6 quarters. My sense is that once the Fed completes its work, there will be a reaction by fiscal authorities, both to inflation fighting, and the contraction that's coming, whether it's a deep or shallow, and no matter what the